Welcome back to Investing with Confidence. I am your host, Joshua David, having a good time talking about the financial markets, the stock market, options, futures, and Forex, and mainly how the smart money is utilizing them. The great thing about those is these techniques and strategies are also available to us, the public. Also, don't forget to subscribe to the podcast wherever you listen to podcasts and on YouTube. As we continue this discussion about these other assets, we want to kind of refer them into retirement or talk about them, why the smart money uses those for retirement, retirement income. They're using the stock market, obviously. They're selling mutual funds, right? Now think about this. If the public is buying mutual funds from the smart money, the banks, the brokers, the advisors and everything, right? But the advisors aren't investing in mutual funds. That sounds like one of those do as I say, not as I do type of things, right? Why is that, for one? And then let's get into some of the different things that the average investor can do as an alternative.
Well, why? Let's ask first of all, why don't the smart money people? Why don't the institutions use mutual funds? There's a number of reasons. Number one, you can't short a mutual fund. You can't really have protection on a mutual fund. The returns are honestly mediocre at best. Probably 90% of the mutual funds underperform what they're supposed to perform with.
Okay, before you continue, what is shorting? You mentioned shorting.
I did. Yeah, shorting is making money in a down market by basically selling something you don't own with the promise of returning it, hopefully with a profit. So if you sell it, you're doing the opposite of what you normally would do. In a normal stock position, you would buy something as low as possible, sell it as high as possible. When you're shorting, you sell something at that high point, and then since you've borrowed it, you have to return it. You hopefully buy it back at a much lower price, and the difference then is your profit. That's shorting.
And just to give another example, too, when people buy, they open low and close high, right? You can do the same thing. You just open high and sell low. So don't get the terminology messed up. It's just opening and closing. That's all it is.
Yeah. And most people that have this explained to them still have a hard time understanding it or accepting it with the first time they hear it. So we go over that in more detail in the classes. It's something that, all of these things, regardless of what the terminology is, regardless of what the strategy or the asset is, that there is knowledge and there's education in that. And there's not only knowledge, but there's also skill building, because one is really one is not of any value without the other. In other words, knowledge is of no value unless you have skills, and you can't have skills unless you have the knowledge.
Yeah, think about it this way too. I mean, when I first started understanding that concept, I didn't understand it.
Sure.
And a wise man that came long before me once said, "It's because you can." Just don't worry about it. Just you can utilize these strategies. So, continue that discussion about the mutual funds.
Yeah. And people that are hearing things that they might not have heard about before, maybe you know nothing about futures. You know nothing about Forex. You know nothing about options other than what you might have heard in a negative fashion. Well, it's because the fear there is really because you don't know them. You haven't been exposed to them. Somebody hasn't taught you how they function, why you would use one over another, when you use one. It's all part of the mindset, changing the mindset from one of just following what Wall Street has conditioned you to believe, which is you can only make money by buy and hold. Don't worry about corrections. Don't worry about crashes. The market always comes back. And truthfully, it does. It always has. But what you're losing is time, years of what could be a portfolio providing a benefit for you instead of fighting itself out of a hole. We talk about this often, where if you have a 50% loss in your portfolio, you have to have a 100% return just to get back to where you were before, just to get back to break even before you can have any potential for profit. So following that strategy where you don't pay attention to crashes, to corrections, is not the best recipe for you for having a potentially attractive portfolio down the road. When you retire, for example, you think about it, let's step back for a second, you're still working. What is one of the reasons that you work? It's because you have bills that have to be paid. The cost of being alive is there. You have to have food, you have to have shelter, a number of things that people require to basically live. Well, those things don't go away when you retire, but your income from your job does. So it's great now, especially before you retire, to think about that and to ask yourself, what are you going to use to replace that income? How are you going to pay those bills? Still have some money left over to maybe go visit your grandkids, your great grandkids, have some fun. Where does that come from? And for most people, it's just what they have left over in their employer-sponsored retirement plans, or for, unfortunately, a lot of people, it's just what Social Security provides.
Yeah, a lot of those reasons that people are having struggles with retirement, getting there with confidence is those mutual funds. As Al was talking about, they underperform. I think the stat is 90% of them actually underperform the market. Mm-hmm. The big thing is the fees, and I know we're going to talk a little bit more about fees a little bit later. Al, I mentioned the word confidence earlier. A lot of people are not getting to their retirement years with that confidence. Mm-hmm. And we were talking a little bit earlier. We're one of the pioneers of building more confidence in trading and investing. I mean, you were talking about you're seeing it everywhere right now.
Correct.
Right? I mean, how do you build that confidence?
Well, you build it by providing the proper education. If you're going to be doing something, I don't care what it is, you want to understand what it is you're doing. If you're going to fly a plane, you want to know how a plane flies, how it gets off the ground, how it comes back onto the ground. You want to understand, how to make sure if you get in the cockpit, you understand what to do. The same thing is true in trading and investing. There are right ways to do it, and there's wrong ways to do it. And then those ways may change depending on the market conditions. So be prepared to take advantage of any market condition, but be able to do it with the confidence and the comfort of knowing that if you're wrong, it's okay. And it's okay because you know how to manage that part of a trade. We always talk about the fact that a small loss can never become a big loss. And understand that you are not going to be right 100% of the time, but you don't have to be. And that's one of the keys. If you learn how to approach an asset or approach the markets the proper way with the proper reward risk ratio, which we help our students to identify, then you don't have to be right even 50% of the time to have the potential to be successful. But manage both parts of a trade. Manage it if you're correct, because you want to get the maximum profit out of a trade, and manage it if you're wrong to protect your capital, protect your principal. Those are all parts of a plan that everybody should have when they're investing in trading. That plan not only should be the kind of the GPS system, the guide that takes you down the path of following the right steps to go from where you are to where you want to be. Every time you do a trade or investment, would it be great if you only had one strategy to use? You had a set of rules that you follow for every trade or every investment. Maybe those 6 steps get you to the point where with the proper trading platform, which our students have, it's a trading analysis decision support system called Click that tells you whether it's a good trade or not. In fact, it will actually come up with an alert telling you if you should stay away from that particular trade. Maybe you're violating your risk level. Maybe you're violating some of the parameters that are specific to you. And that's part of what helps with the confidence, too, is knowing that you have one strategy to follow that has been proven to work on a consistent basis, giving you the opportunity to be successful.
You're right. I mean, I do believe that plan as well is probably the number one thing, is having the proper plan to make better investing decisions. Coming up next in this final segment, Al, I wanted to continue this discussion about retirement because we've got to get to talk about self-directing.
Right.
What that really means. What are some of the things that us as the average investor can do in retirement accounts, but do that on our own with that confidence? This is Josh and Al. We'll be right back.